Hey guys, welcome back. So today I'm going to talk about which market to trade or which markets to trade. Now, similarly with the over-analysis subject that we've talked about before, and go and check that video out if you haven't checked it out already, you can really bombard yourself with the problem that it's just too much. In other words, there are too many markets to trade. We are so lucky now that we can trade pretty much any market we want. Yeah, there are some restrictions on trading some foreign markets out there and some foreign stocks, but you know what? There are thousands of markets that are available to us. How do we even pick the right one for us? Now I'm going to talk about that in the next couple of videos. I'm going to talk about why we should choose it, how we select the right market for us, and what are our options. So let's look at, first of all, some of the big things that we can trade and some of the kind of structures, some of the kind of categories we can trade. So we've got the big one, which I'm pretty sure you've heard of, is the foreign exchange market. Okay, that is one of the biggest ones out there and it's quite a popular one. Is it the best one? Subjective. It's subjective. Then we've got stocks or shares, depending on whether we're talking about a US market. That's generally only the differences between a stock and a share. Share is a UK, stock is US. Generally, I'm sure there's a very much more geeky definition than that, but as a trader, I don't really care. I'm just looking for movement in the market. The other things we've got are indices. Okay, and we'll talk about those in a second. And the final one that we have is, of course, commodities. Now, there are more out there, but I'm just going to use this as the four main primary ones. Right, so these are the choices we've got. Now, if we're trading Forex, the big countries we have are US dollar, which trades obviously in the US, United States of America, Japanese yen, GBP, which is obviously pound, and euro. Now, they're the biggest kind of currencies out there because they're the biggest economies. However, there are other ones, and you know, my advice generally is, before we go down this rabbit hole, is that stick with the bigger ones first, because the bigger ones are cheaper generally to trade, because more people are trading them, the spreads are going to be tighter. That's not necessarily where you want to end up as a trader. You might end up specializing in something, an exotic pair, because you've noticed a strategy or setup that works for you and it works very well. And that's absolutely fine. I'm a really big fan and an advocate of specializing where you can. However, if you're starting, there's nothing wrong with starting with these big boys. Now, generally speaking, you've got the biggest ones are going to be Euro, US dollar, GBP, US dollar, and US dollar JPY. So it's basically the US dollar crosses, and how they're structured. We'll talk about more of that in another video, but ultimately allowing you to trade one currency against the other. Now, the interesting thing comes that these are the ones that most people trade, okay? And they're the thickest, the spreads are very, very tight. There's a good way of getting involved in the market, good way of getting involved in the currency market. You trade for 24 hours a day, you know, except for the weekends. You've got loads of liquidity there. It's a good place to cut your teeth. You can trade a very small size. You can get used to it. You can kind of, you know, just get a feel for trading in general. It's a place where most people start, and unfortunately it's a place where most people end as well, because they don't get past that point of struggle, and they don't move on, and they don't try something else. They might try one of these other things just out of kind of, you know, just thinking I might try something else, but they never get a feel for it. And again, we'll talk about kind of the pathway of a trader in another video. So make sure you're subscribing, because we'll have more of these coming forward in the next week or couple of months or so. But the important thing to note here is that if you're trading these, you can also trade subsets of these. So it's all these permutations. So you can also trade GBP, JPY. You can almost trade Euro, JPY. So basically you can mix and match whichever way. Now those are the three big ones. But when I'm trading a currency pair, this is obviously my choice, I like volatility. That is all I'm concerned about. I'm not interested in anything else but volatility. That's just a personal preference for me, because I know that I perform better in volatility environments. That's where I make more money. I cannot trade quiet environments at all. I will lose money. I know my strengths. I know my weaknesses. I know that if I'm in an environment where it's choppy and it's bad and I'm forced to trade, I will lose money. Just our history, I just know over the years, that's exactly how it behaves. So for me, I look for volatility. So how would I pick a currency pair to trade from a volatility perspective? the first thing I'd do is I'd say, what is moving at the moment? What is economically under uncertainty? Is it the US dollar because something's going on with the presidency? Is it the Japanese yen because of something they've got the monetary policy? Is it the euro because of countries leaving? Whatever it may be, or is it the country leaving the euro? Whatever it may be, okay? Something will be a catalyst to cause volatility. So then from my perspective, I might say, okay, Japanese yen is looking like a reasonably volatile currency at the moment. So which one do I then decide to trade? Do I trade US dollar yen? Do I trade euro yen? Do I trade pound yen? Do I trade some other country against the yen? How do you make that decision? So to make that decision, this is how my decision-making process would go. I would look for either a weakness or strength, depending on what I'm looking to do in the currency. So if it's a weak currency, I'm going to look for weakness overall in that currency. Then I'm going to look for the opposing currency to be the strongest it can be, because that is going to apply this kind of force. Weakness from the yen and strength from, let's say, the euro. So whichever which is going to cause much more of a violent move than if you've got a weak yen, a weak euro, but the one's just slightly weaker than the other, if that makes sense. So I'm looking for the most volatile, and I can do that by kind of gauging, looking at all of these different currency pairs independently and saying, hey, the benchmark is, let's say, the US dollar. Euro against the US dollar. Euro is pretty weak against the US dollar. Okay, that's not very good. Oh, pound US dollar. Pound's very, very strong against the US dollar. I already know the yen is weak, so I may now trade pound yen because I've got strong pound, weak yen. That's going to cause much more of a violent move in the currency pair over a day, over a week, over a month, whatever it may be. So that's a good way of doing it. Spreads are really tight on those. Euro US dollar is probably the tightest one. It's the most liquid out there. Doesn't necessarily mean it's the best one to trade, guys. You know, if anyone says to you, oh, well, it's $1 trillion market, that's why I trade currencies, you need to just go, okay, take a step back here. You're a real small fish in a big ocean. You don't need $1 trillion to unwind. And if you're watching this video and you have got 5 or 6 billion to put to work in the currency market, then maybe you need to look at the euro or US dollar. But for the majority of us, any of these will suffice. The spreads are low. It's very cheap to trade. Loads of liquidity there. It's not a problem.